Our company is Flashy Inc. We are Team 4. Our members are Liliana Lopez, Reth Ray, Jessica Rico, Akshay Sani, Caitlin Sharma, and Samantha Sismundo. Flashy Inc.'s mission statement is to be an international industry leader by offering a unique brand while creating customer loyalty and expanding globally. Our mission is to offer high-quality products at the best possible price and constantly offering new products with improved qualities and features. Our company structure makes it so that all the managers have equal say, and our CEO is Jessica Rico, our accounting officer is Reth Ray, our financial officer is Samantha Sismundo, our operations officer is Liliana Lopez, our human resource officer is Caitlin Sharma, and our marketing officer is Akshay Sani. For our weighting factors, we based the highest points on return on assets and return on equity. For return on assets, we put 5 points because we thought we would do well in this area. We, however, were below the industry average. For return on equity, we thought we would do well in this area, so we assigned it 7 points. We were, however, below the industry average. For market share, we thought we wouldn't do as well in this area, so we only assigned it 2 points, but we ended up being above the industry average. For stock price, we only assigned it 3 points, because our stock price is low, it's at 85 cents, and the industry average is at $1.50. Unit production costs, we only assigned it 1 point, because we know we have the highest unit production costs in the industry. For total net income, we only assigned it 2 points. We were below the industry average. That was because in year 6, quarters 3 and 4, we spent a lot on advertising.
So next I will be talking about the marketing, financial, and operational strategies for Flashy Inc. So for research and development, each quarter for year 5 and 6, we invested about $250,000, which allowed us to have new models available to our customers quicker than our competition did. And our year 5 was actually higher than our year 5 actual was higher than our planned, because for one quarter we actually invested about $50,000 more than we normally do, which resulted in $300,000 for one quarter as opposed to $250,000 we did previous quarters. And then our year 6 plan was actually higher than our actual, because towards the end of the game we decided to decrease our R&D. So our advertising expense was something that fluctuated from quarter to quarter just depending on what model was being released. So when we were releasing a new model, that's when we increased our advertising. However, in year 6, quarter 3, we decided to increase our advertising expense to $350,000 for each area, and hoping that this would positively affect our benefit or our company. However, it did give us a negative income, and then we dropped back down to our normal advertising expense. With pricing, our company was actually really inconsistent with pricing. From year 5 to year 6, we experienced a $2 drop in price, and this was because we felt that our high price, high quality strategy was not working well for us. So when we released Model 5, we decided to decrease our price and produce a cheaper quality product. And this completely altered altered our pricing strategy because we felt that that was the best at the time. And our planned sales were actually lower than our actual sales, which was good for us. However, it was still lower compared to our competition. And the one area we struggled in the most was Pandao. For production lines and output, for year 5 and 6, we had active lines of a total of 10. We had 6 here in our home base and 4 overseas in Pandao. And that was something that we struggled in because we were hoping that we would have more production in Pandao and less production domestically, because here our UPC would be way more expensive than it would be if we had produced most of it or majority of it overseas. And of course, our domestic output was more than our overseas output. For both year 5 and 6, our planned overseas was much higher than what we actually produced overseas, and that was something that we had struggled in for the course of 6 years. And lastly, our financial strategy. Initially our company wanted to finance our debt or our expenses through investing or through issuing stocks to investors, and from the beginning of year 1 we issued a majority of our stocks, and our main goal for year 5 and year 6 was to repurchase back those stocks to gain control and to increase our stock price and market share. So our plan for year 5 and 6 was 200,000 stocks per quarter, but our actual was almost double that, which was 500,000 stocks per quarter for both year 5 and 6. And as a company, we did not find it necessary to pay dividends, but in the future I believe that we are going to pay some dividends.
Year 6 income statement variance analysis. When comparing Year 6 income statement actual with projected, there were several variances that exceeded 25% or more, starting with the cost of goods sold. The high variance in the cost of goods sold of 68% was due to Flashy Inc. producing majority of their inventory in Miracle 2 plant instead of the plant in Pandao. The initial plan was to close 2 new lines in Miracle 2 and open 2 new lines in Pandao. After factoring in the costs and time it will take to open 2 new lines in Pandao, management opted out. Additionally, the high cost of goods sold was also due to the company products being of high qualities and features. The next variance on the income statement is the advertising expense, a variance of 133%. Advertising expense had been consistent with what was forecasted throughout year 5 and year 6, with a slight variance of less than 5%. The company was not doing too well in sales, so in an effort to boost sales, Flashy Inc. increased advertising expense in year 6, quarter 3. This is what caused the high variance in advertising expense. Next is the general selling expense, a variance of negative 29%. Flashy Inc. general selling expense was over forecasted in the 2-year plan. Management expected a higher amount of general selling expense to be obtained by the company. Research and development has a negative 32% variance. Flashy Inc. was determined to introduce as many new models as possible up to Model 12. The company had invested a lot of money to make this possible. Flashy Inc.'s last model introduction was Model 5 in year 6. Model 6 was available to launch in year 6, quarter 2. However, just being 2 quarters away from the end of the year and not near Model 12, management cut down R&D in year 6, quarter 3 and 4, which explains the negative 32% variance in R&D. Operating profit has a negative 73%. Actual operating profit less than forecast due to the high cost of goods sold and other factors already mentioned in selling expense and admin and general selling expense. Net profit had a negative 81% variance. Income tax expense had a negative 65% variance, and net income after tax had a 105% variance. Flashy Inc. sales forecast was less than actual sales, but forecast net income before tax was more than actual. This was probably due to the high of actual cost of goods sold. The variance in projected income tax expense being higher was due to a miscalculation in the 2-year plan. Flashy Inc. SWOT analysis. Some of the strengths of the company are high quality and feature product, new model launch quarterly, and good cash flow. Products of high qualities and features. Flashy Inc. wants to offer its customer the best products in the industry. The main focus of the company is producing products of high qualities and features. The company is known for its luxurious items and has built a strong, loyal customer base. New model launch quarterly. Flashy Inc. customers look forward to the company introducing new products to its lines. The company invests in a lot of R&D to make this happen. This is to keep the customer happy so they can keep coming back. Good cash flow. The company has a mass amount of cash. The company maintains a good cash flow because utilizing its asset is how the company finances their operation. Some of the weaknesses of the company are high cost of goods sold, high product pricing, and limited production line. Due to the company offering products of high qualities and features, the company in turn has high cost of goods sold. High cost of goods sold has affected the company bottom line. High product pricing. Due to the company products being of high quality and has high cost of goods sold, its price is on the high side. Limited production lines. Flashy Inc. inventory output cannot exceed 512 per quarter. This is due to the company only having 10 lines. This is a disadvantage for the company because the company cannot fulfill off its orders. At times, the company has to pay overtime in order to fulfill orders, which increases its expenses. Some of the opportunities for Flashy Inc. are expanding production in Pandao and increase sales through marketing and advertising. More production in Pandao. Opening new production lines will help the company fulfill more orders, which in turn would increase sales. Plans of new lines would be mostly overseas in Pandao. Currently, the majority of inventory being produced is in America too, which is the reason for the company cost of goods sold being high. Increase sales through marketing and advertising. The company has an opportunity to increase their sales by heavily increasing advertising and marketing. Research on consumer preferences will help aid in determining which market to focus on and what products to sell in that market. Having a better knowledge of what consumers want in which market will give the company an upper hand. Some of the threats are price competition and the economy.
I will explain Flashy Inc.'s Year 6 balance sheet variances. When comparing Flashy Inc.'s Year 6 actual results with those projections from the pro forma statements presented in the 2-year plan, it can be seen that there are some items with a variance greater than 25 in either direction. I will go ahead and explain why such large variances occur. First, we will take a look at the financial performance variances of assets. The financial performance variance for accounts receivable was 35.58%. Flashy Inc. had a higher amount of accounts receivable in every quarter of year 6 than the one expected. I will now explain the financial performance variances of liabilities and equity. The financial performance variance of taxes payable was 44.68%, which was lower than predicted. This was the outcome from lower net income in comparison to the forecasted number. For capital stock, the financial performance variance was 30.81%. Flashy Inc. stock was predicted to be higher than the actual. However, from year 6 quarter 1 to year 6 quarter 4, capital stock steadily decreased. The variance occurred because early on, Flashy Inc. issued stock and repurchased some of it back. Next, for accumulated earnings, the financial performance variance was 53.82%.